It is always nice to have some good news in what seems to be an endless sea of economic bad news. And, if there is any good news in today's economy, it is that bank earnings seem to be okay. When it comes to gauging the financial health of the U.S. economy, analysts tend to look closely at the earnings of the major U.S. banks. As you know, banks are highly regulated. Banks became even more highly regulated in the Great Recession when it was feared that many of them might fail. So, if you recall from the time, the Federal Reserve started requiring that all banks pass stress tests. And, they must have their capital plans approved by the Federal Reserve before announcing them to the world. The capital plan of a bank has a number of elements. But they focus on the bank's ability to have enough capital to survive a major shock to the U.S. economy. And the capital plan includes how much will be paid in dividends. And how large any stock buyback can be. Stock buybacks are pretty much a standard part of any big bank capital plan. Starting in 2022, the Federal Reserve now requires that banks submit capital plans quarterly instead of just yearly. So, everyone is looking at the earnings reports of banks and the results of the Fed's stress tests. The good news for now is that Q3 earnings are mostly out and they look reasonably good. Bank of America reported today and their CEO expressed optimism about the U.S. economy. So, the financial doomsday can be postponed, at least for a few months. And if you follow this channel, you already know the main financial narrative of these times. Inflation is raging in most countries of the world. Central banks all over the world are raising interest rates in order to fight inflation. Wall Street analysts are cracking down on unprofitable tech companies that basically are not growing anymore. So layoffs are sweeping the United States. As a result, consumers are not so confident in their job security. So they are pulling back on spending. Because of that, corporate marketers are cutting their ad spending. And ad spending is the lifeblood of tech companies. So, tech companies of all sizes are having layoffs. Banks seem to be reporting better earnings than expected. What does it mean for the U.S. economy? And, what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. In the latest batch of bank earnings reports, Bank of America CEO Brian Moynihan cast some sun rays on the U.S. economy. Consumers are financially resilient, despite high inflation and concerns the U.S. is nearing a recession, said Bank of America CEO Brian Moynihan. Analysts might wonder whether the talk of inflation, recession and other factors could result in a slower spending growth, Moynihan said Monday during the bank's Q3 earnings call. We just do not see that here at Bank of America, said Moynihan. Bank of America customers continue to keep up their consumer discretionary spending. Our customers are using their credit cards and other payment methods for 10% more transaction volumes in September and the first half of October than a year earlier, Moynihan said. While price inflation accounts for some of that, the number of transactions also rose 6%, he added. Customers' account balances remain higher than before the coronavirus pandemic struck in early 2020, Moynihan continued. Credit card account balances are a good indicator of consumers' willingness to spend. And, from Bank of America's perspectives, consumers believe that they are in a good position to keep spending. And, that is particularly true for customers who carried lower balances. In fact, credit card account balances were 5 times higher than before the pandemic. Finally, consumer credit remains pristine, with late payment metrics still well below pre-2020 averages, Moynihan said. That indicates that customers had little difficulty keeping up with their debt, Moynihan added. Early-stage delinquencies are seeing a slight tick upward. But, late-stage delinquencies are running 40% lower than before the pandemic. So, that is all great news on the health of the economy. And, it tends to dovetail with what we have been hearing from the chairman of the Federal Reserve. Despite the wave of layoffs sweeping the United States, the job market remains fairly strong overall. The unemployment rate is still low by historical standards. People might be afraid of losing their jobs. But, they remain confident that, if they do lose their job, they will get a new one fairly soon. If you recall from last week, JP Chase reported Q3 financial results that exceeded Wall Street expectations. As you probably already know, JP Chase's biggest U.S. bank is measured by assets. Rising rates were the key factor in enabling the bank to generate more interest income. Revenue jumped 10% over 2021 to $33.49 billion for Q3. Generally speaking, banks earn more when interest rates are higher. And, since the Federal Reserve has aggressively raised interest rates, banks have benefited. While consumer and businesses were financially robust in the period, the economic picture was darkening, said JP Morgan CEO Jamie Dimon. There are significant headwinds immediately in front of us, stubbornly high inflation leading to higher global interest rates, Dimon continued. Profits for all banks are being helped by rising interest rates. And stock market volatility has been a tailwind to fixed income traders. Despite all of that, shares in big U.S. banks have not performed well at all. Investors are concerned that the Federal Reserve will inadvertently trigger a recession. And investment banking deals have basically collapsed. Add to that, the weakening macroeconomic environment is leading banks to increase reserves for loan losses. Third quarter investment banking revenue was headed for a decline of up to 50%, said JP Morgan President Daniel Pinto. This decline is largely due to the collapse in initial public offerings and new debt and equity issuance. On the positive side, trading revenue was up 5% jump from Q3 of 2021, largely due to strong fixed income activity. U.S. Bank reported profit of $1.81 billion or $1.16 per share versus $2.03 billion and $1.30 per share in Q3. And, overall, big U.S. banks are navigating a rough economic patch reasonably well. The Federal Reserve is expected to continue aggressively raising interest rates this year. Their chairman, Jerome Powell, keeps repeating the mantra that the U.S. is in a period of high inflation. In fact, every time the stock market has a rally, Powell makes a high-profile doomsday speech. Is the Federal Reserve actually causing deflation by raising interest rates while it says that it wants to fight inflation? ARK Fund's CEO Cathie Wood thinks that the Federal Reserve has actually crossed over the line by raising interest rates as far as it has. Wood thinks that the Federal Reserve is focusing on lagging indicators while the situation on the ground is changing quickly. Cathie Wood thinks that Federal Reserve Chairman Jerome Powell is making a huge mistake as he continues to raise interest rates. Wood says that Powell is on a path of outsized interest rate hikes to tame inflation, and it is a disaster in the making. Even the oil price has dropped more than 35% from its peak, erasing most of the gain this year, she said in a tweet on Wednesday. Many commodity prices have plunged and are trading at or near pre-pandemic levels. In the pipeline, inflation is turning into deflation, Wood said. Retail company inventories have swollen in the past few months, compounding the reversal of inflation into deflation. The Federal Reserve Chairman is signaling another 75 basis point increase in interest rates during its September meeting. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.